So welcome back to our discussion on financing decisions and the financial statements. So we saw that the company has an option to either finance a business through net worth, that is equity, or liabilities. Now let us try to understand that by taking two Indian companies, let's say two different sectors. One is Hindustan Lever, which is an FMCG company, other Infosys, which belongs to an IT company. Interestingly, these two financing decisions fall in two extreme categories. For example, Infosys is out and out an equity based or equity financed company. In fact, more than 84% of the total assets of equity are financed by equity, and a large percentage of equity is actually their retained profits. Whereas in case of Hindustan Lever, quite a small percentage, that is about less than 30%, to be precise, about 24% of the total assets are financed by equity. So where is this money for Hindustan Lever coming from, the balance money? It's interesting to observe that Hindustan Lever uses the current liabilities to finance its assets. That means the current liability in fact accounts for more than 70% of the total sources, or in other words, 70% of the assets of Hindustan Lever are financed by current liability. Interestingly, the net working capital, that is the excess of the current assets, current liabilities over the current assets for Hindustan Lever is negative. So in one of our sessions we'll see what's an implications of negative working capital. So coming back to the financing here. So Hindustan Lever, unlike the Infosys, is depending more on short-term financing, whereas Infosys depends on long-term financing, and in the long-term financing it's an equity, and in the equity it is a retained profit which is financing its business. But that can trigger one more question: is Infosys not declaring dividend? Answer is no. Infosys is declaring dividend, and a part of profit is retaining. Hindustan Lever is also declaring dividend, but the amount of business required or money required is more fueled by or more financed by the current liability. Now let us see what's happening with the long-term debt for these two companies. Hindustan Lever is about 5% of the total assets are financed by the long-term liabilities, whereas all know that Infosys is not depending on, is not using any of its long-term loans for acquisition of assets or its business. So that means from a purely debt equity ratio, so Hindustan Lever is a very low debt equity ratio, but whereas Infosys has no debt at all. So as we mentioned in the last class or last discussion, we saw that debt equity ratio may be, a low debt equity ratio may be good, but there are companies like Infosys, there are companies like many IT companies which have no debt at all. So the large chunk of the financing happens from the equity. And that may not be the case with every FMCG or every IT company, but Infosys has been consistently driven by equity. Let me put some more numbers. For example, Infosys, the net worth of the company is about 2,060 crores. And total assets of Infosys is about 8,050 crores. Whereas the total funds, the shareholders' funds, as I mentioned, is accounting for 84% in 09. It was 78% in 08. It was 86% in 07. So that means the increase in assets of Infosys has been continuously being funded by their own profits. In the last few years, Infosys actually not gone for new public issue, so that the funds raised by the business are purely from the profits that they are generating. In the same way, Hindustan Lever is current liabilities have been consistently increasing. In the previous year, 78%. Previous to previous is about 63%. So a question can come to mind that where is this money for Hindustan Lever coming from? Some say that it is a supplier which is financing the business. It's not the shareholder, it's not the loan giver, but the supplier. But obvious question is supplier's money cheap or is equity money cheap? So these are the questions which we might see in the next classes. To understand that the financing should not be seen in isolation, should be seen in the context of the business, in the context of the industry in which we are trying to understand, and also within that industry, the cost of that money. For example, to absolutely a person who has not gone into any balance sheet analysis, it seems that the short-term funds is considered to be costlier than long-term funds. But why is Hindustan Lever using short-term funds? How is Hindustan Lever using short-term fund is a question that we will discuss later. Thank you very much.